All right, financing in a seller's market, i.e. means hot real estate market, i.e. means limited inventory market. Yeah, all of that. That's where we're at today here in the Phoenix metro area. So I thought it might be helpful to really kind of chunk down some of what we're seeing and then just how to walk through knowing the numbers. I'm going to show you all of this and more, but before I do not forget to subscribe to this channel. All right, here we go. Now more than ever, I'll tell you most of the contracts we're receiving in today has the appraisal contingency waived, meaning that no matter what the house appraises at, the buyer is going to purchase the property not dependent on the appraisal. Okay, so I'm going to walk you through the math on that here in a second. But outside of that, inspection periods are being waived or reduced. So the standard inspection period is usually 10 days. Well, guess what? I'm seeing 0 days, 5 days, 3 days. So inspection periods, that's the due diligence time frame, is being waived. All kinds of crazy stuff. And most often, the price of the home is actually exceeding the price that the house was listed at, without a doubt. So in that scenario, from a lending perspective, we've got to educate people and make sure that they understand how the numbers work. And I think doing that upfront, which we do with conversation, we do that with a mortgage coach cost analysis, we're really walking people through. Here's how it looks if the house does appraise at the purchase price. Here's how it looks if the house doesn't appraise at the purchase price. And here are some options. So on a quick note, I thought we'd just sketch it out. So let's say this was actually a conversation I just had. The actual purchase price is $650,000, okay? So that was the purchase price. Now the real estate agent doesn't think that it's going to appraise more than $600,000, all right? Now, of course, until the actual appraisal is done, we won't know for sure, but we wanted to be sure that we were walking through the projected numbers with the buyer in the contract negotiation phase, so they understood if the house in fact only appraises at $600,000 versus the purchase price of $650,000. The math, right? Got to know the math, got to know the numbers. So at a $650,000 purchase price, these buyers were doing 20% down. So it's $650,000 at 20% down. The estimated loan amount was $520,000. Okay, so easy peasy, works out the door. But let's say that the house in fact appraises for less than the purchase price. Important to know that from a lending perspective, the lender is going to lend on the lower of these two numbers. So if the house purchase price is $650,000, but the appraisal comes in at $600,000, this is the number that's going to drive the down payment. Plus, the buyer has to make up the difference. So here's the math. So let's say on the $600,000, the buyer is still going to do the same down payment, which in this case is now going to be $120,000 down, which will set the loan amount at $480,000. Okay, so loan amount goes down, so they're going to come in with the 20% down, which in this scenario is $120,000, plus they have to make up the spread between the purchase price and the market value, which is another $50,000. So now their total funds out of pocket, assuming the same down payment, is $170,000, as opposed to if the house appraises at the purchase price at 20% down, that's $130,000. So you can see that really understanding the numbers is key. But I'll tell you, there's a whole nother strategy here that people aren't really thinking about. And that is, all right, let's say that our borrower only had this amount allocated for down payment, so they can't come up with $170,000. Okay, that's all right. Let's look at the numbers in that situation. So what we will walk people through is, instead of doing the 20% down payment, we might say, okay, let's do 15% down. All right, so $600,000 at 15%, which is now $90,000 on the down payment, plus the spread here, right? Between the purchase price and the market value is $50,000. So the total cash out of pocket in that scenario is $140,000, right? So a lot closer to what their initial down payment was. So this can go to 10%, this could go to 5%. There's all kinds of options here. So don't let the fact that you may have to go above the list price dissuade you from continuing that offer if that's the house you want. Because depending on your assets, depending on your loan strategy, there may be a way to accomplish it. Now, the disclaimer is, if you're putting less than 20% down, yeah, you're gonna have to pay mortgage insurance. Remember that. So, but paying mortgage insurance isn't the end of the world. And if you understand the numbers and you have the funds, there is a way to really just get your arms around it so you can continue with that negotiation process. Without a doubt, all day long, we are having these conversations every day. So your head's probably spinning with all of this because I talk fast, right? So be sure to check out the Mortgage Coach Home Finance Analysis, where I'm going to show not only this with a 20% down payment, but 15, 10, and 5% down. It's going to include an estimated interest rate, the APRs, and the cost of the mortgage insurance, which I'm sure you all were wondering, yeah, Kelly, what does that add to my payment? Well, check it out. Let's face it, this market is a whole new game. And part of really being able to win in a seller's market where there are multiple offers on properties is really making sure that the buyer understands the numbers, best case and worst case. So today, that's what I'm going to walk through. It's just a scenario that we are finding very often and having lots and lots of these conversations. I use Mortgage Coach in my day-to-day business because I am a big believer in empowering people and chunking down all of the numbers and everything else that goes on in the home loan process and providing a transparent side-by-side comparison no matter what their particular situation is. So this one, we're going to focus on a sales price of $650,000, and we're going to assume that the buyer knew that the house wasn't going to appraise for the purchase price, because the list price in our scenario today was $600,000. So in our total cost analysis, I'm going to show you best case scenario and kind of worst case scenario. And I think really when you start to see it side by side, it gives options to the buyer because now they're not so freaked out. They can see it and they can go, okay, I got that. I can do that. Or maybe they can't. And it's okay if they can't, but really being able to articulate how it all comes together, that is the big win here. So in scenario one, we are assuming a $650,000 purchase price, and we're going to assume in scenario one that the home appraises. And in this scenario, the buyer was putting down 20%. So 20% down sets the loan amount at $520,000. The monthly PITI payment is estimated at $2,685, and the funds to close are estimated at roughly $136,000. So those funds to close are including the down payment and the estimated closing cost. So cash to close. All right, now this is reality, guys. This is where it's all starting to happen in this market. So now the appraisal comes back, and the house price is $650,000. The appraisal contingency was waived, so now there's no allowance to walk away if the house doesn't appraise and get their earnest money back. So the buyers know this. They're waiving that appraisal contingency up front in many cases, and the house appraises at $600,000. Now what? Well, it's really important to know that from a lending perspective, the lender's down payment threshold is going to come off of the lower of the two, the lower of the purchase price or the appraised value. So in this scenario, the 20% down payment is now going to come off of the appraised value of $600,000 as opposed to $650,000 purchase price. And so essentially what that means, which is reflected in column 2, is that the down payment is 20% of $600,000 plus the buyer is going to pay the difference between $600,000 and $650,000 purchase price. So in this scenario, the estimated funds to close are $176,242.
That includes the down payment of 20% off of the $600,000 plus the difference in the sales price to the appraised value and closing costs. So, okay, all right, so that's a little bit more money than the buyer was initially thinking, but that's what that number looks like. And it keeps the total PITI payment right around $2,470. Okay. All right. Now we're going to move into column 3. So if we have a buyer who maybe only had $150,000 to put down, now we've got to get strategic. So column 3 is going to introduce another thought, another way that this might be able to work. And so in this scenario, instead of doing 20% down, we're going to show a 15% down payment. And remember that 15% down is going to be based on the $600,000 appraised value, plus they're going to go into closing with the difference between that appraised value and the purchase price. So in this scenario, column 3, the total monthly payment, $27,026, that's PITI, and the funds to close in this scenario are about $146,000. So again, remember that $146,000 includes their 15% down payment based on $600,000 appraised value, plus the difference between the $600,000 appraised value and the purchase price of $650,000, so that $50,000, as well as estimated funds to close. So that's scenario 3. And then lastly, scenario 4 is just a whole different picture. So maybe as people are going through this process and maybe the house needs some repairs and they want to retain some of that cash. So scenario 4 looks like this. Same scenario. So the purchase price of the house is $650,000. The appraised value is $600,000. The 10% down payment comes off of the $600,000 number. Plus they're going into closing with the other $50,000, which is the difference between the appraised value and the purchase price. So in this case, the total monthly payment, principal and interest, taxes and insurance, and mortgage insurance is $2,917, and the funds to close are about $116,000. So this just gives the buyer, again, that transparent look at, okay, I know that I might be overpaying for this house, and maybe it'll appraise, maybe it won't, but I've got it. Now I know my options, and this empowers people and educates people so they can go through and navigate this market with success.
If you got value out of today's video, please like this video. If you have questions or comments, please comment below, and don't forget, subscribe. We'll see you next time with more valuable mortgage information.